day, fellow investors. The three keywords when it comes to value investing are margin of safety. We'll discuss 10 ways to estimate the margin of safety, the definition, Berkshire as an example. But if we immediately go to Warren Buffett, when you build a bridge, you insist it can carry 30,000 pounds, but you only drive 10,000 pound trucks across it. And the same principle works in investing. The only problem is that if you go with 10,000 pound trucks on a 30,000 pound bridge, you need to go 3 times over it. It is more expensive, it is slower, but it is certainly more certain. When the bridge collapses, those going with big trucks lose everything, and that's the essence of value investing. Margin of safety, never lose money, compound for the long term. I've just updated this on my free value investing course, so these are the topics. We'll define it, estimate it, and use also Berkshire as an example of how all these ways help you estimate the margin of safety. For those who don't know, I have a research platform, which is what I do, but there is also the Value Investing with Sven free value investing course, where I update all the educational value investing things. There is the intrinsic value calculation template, now the quadrant risk and reward, the guide for 2025, key questions, how to start investing, finding a broker, and I'll be revamping this course over 2025. So we did the intrinsic value, now margin of safety, and there is already a lot of educational content here, but I think it will be a great thing to update over the year, and I'll send you an email every time I add something new so you can follow. So please join the value investing course there. Let's start with defining what is the margin of safety. If you look at the key definitions, it is the difference between an asset's intrinsic value and its market price. And the lower the price is compared to the intrinsic value, the bigger is the discount or buffer to protect you against potential losses. The key components of margin of safety is the intrinsic value, which you then compare to the stock price, of course, the market price, and then the buffer, the gap between intrinsic value and market price. Here you have the formula. Intrinsic value minus market price divided by intrinsic value, and you get the percentage of margin of safety. If an asset's intrinsic value is 100, trading at 70, the margin of safety is then 30%. Let's go discuss each of these components to see how to best estimate a margin of safety. All businesses are different, so we can have some things that are more important, some things that are less important, depending on the business. Let's start. The first thing we discussed is intrinsic value in a video just recently, and that's also the key core component of the value investing course. You can download for free this template, and we have made a free template to calculate the intrinsic value depending on the input, and everything is discussed, and then you compare what you have as an intrinsic value to the stock price, and you also have here the comparative table, and you can see how most of the great notorious businesses are a little bit overvalued, maybe great businesses but too risky, and there are some pockets of the market that lead to good returns here, but still one has to see how that fits one's portfolio and what is the real margin of safety. Now, when it comes to margin of safety, it is also margin of error. At what price could I buy something so that I cannot lose money? When I discussed here the intrinsic value, I have put scenario 1, the normal case, the best case, and also the worst case scenario. Now, if you go from an educational perspective, yes, you look at what can happen in a normal case, what can happen in the best case, but keep in mind, margin of safety is worst case scenario, am I still good? So worst case scenario for Apple would be that earnings don't grow over the next 10 years. The discount rate, I expect a 10% return. There is a terminal, let's say, P ratio of 12, which means that Apple stock would be $72, $73 in 10 years. Present value of that would be $34, and compare 34 with the current stock price, you can call me crazy. But that would be a margin of safety worst case scenario. You have to be really focused on not losing money when it comes to a margin of safety, because it is also a margin of error. It leaves room for error. What if Apple's earnings crash 50%? Anything can happen in the next decade. So you want to be safe even if those things happen, and therefore you have this approach of looking, okay, what can go wrong? If all that can go wrong goes wrong, am I still okay by buying this asset? That's the core of a margin of safety. Therefore, also on the intrinsic value, be very conservative. Worst case scenario that usually helps. Again, check out the intrinsic value video. I'll put it here in the description too, and then you can have already two components on your value investing journey. The next, margin of safety, Benjamin Graham core. Compare the price to the book value. If you can buy a dollar for 70 cents, you have a 30% margin of safety. And this is now Archer Daniel Midland's, and I want to also discuss here the difference between the accounting book value, so the total shareholders' equity, that's the book value, 22 billion here, and that is what has the value created been by Archer Daniels Midland Company. But that is the accounting value. And nothing wrong here, 22 billion, you compare it to the market capitalization of 25 billion, there is not a margin of safety, but you say, okay, I'm at least getting real value for my money. However, if I dig deeper into the accounting value, I see that they spent 29 billion on property, plant and equipment, and that the accumulated depreciation, the accounting loss of value there, is 18 billion, thus the net property, plant and equipment is 11 billion. If I look at ADM's plants, those have been built over the last 50 years, I would argue also that it would take more than 10 billion to rebuild it. Maybe even 20 with inflation, maybe even 30. So from that perspective, you can also calculate the replacement value of the things a business owns, and therefore this is just the start of equity book value calculation. You need to look beyond all these numbers to know what is the real value there, what's the value of the land, can it be replicated, competition, the cash flows, and things like that. We'll dig deeper into book value, into a specific book value video when the time comes for the course, but we have also here goodwill, that are intangible assets on the balance sheet, which come from acquisitions where Archer Daniel Midland's overpaid for the accounting value, which then again explains this. Maybe the accounting value was much lower than what they paid, but then to be conservative, we can stick to focusing to tangible values and not goodwill. Further, of course, it all depends on the cash flows, but it's always good to look worst case scenario, what can happen. The ultimate margin of safety is always cash, cash, and cash. And if you look at, for example, the company that has the most amount of cash globally, that's Berkshire Hathaway. This is 320 billion in cash. Compare it to the 1 trillion market capitalization. So 32% of Berkshire's market capitalization is in cash. Of course, the times when you could find net normal businesses that have cash equal to the stock market price are gone. I'm not talking some shady businesses that you can still find around the world, but you don't know whether the cash is there or whether you will always get it. 30%, and then you already know, okay, worst case scenario, there is always the 300 billion of cash there that Warren Buffett will deploy in good businesses. So some kind of buffer and margin of safety. The next thing introduced on top of Benjamin Graham's Warren Buffett, Charlie Munger is business quality. As Warren Buffett says, it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. And now let's talk Amazon. Amazon, if we look at the equity, the last reported is 259 billion, but the stock is now trading at 2.5 trillion. And when it comes to Amazon, I think we may also made a video 2 years ago, when it was trading at 1 trillion, I said that the infrastructure, whatever they build, is worth certainly at least 700 billion. Now that 2 years have passed, I would say it's worth certainly 1 trillion, because it simply creates that kind of cash flows. Maybe there will be some slowdown, something like this. But then you look, okay, what's the infrastructure, the connection to customer, the quality of the business, and then you say, okay, at 1 trillion, I would buy, for example, Amazon. So that's also one concept to add on top of the margin of safety calculation. The value of building something like it is there. When Warren Buffett bought Coca-Cola, they calculated, I don't know, the market cap was 15 billion. They calculated that to replicate Coca-Cola's brand power in the world, one would need to spend 100 billion. That was their margin of safety. Now, we have the margin of safety now, but we also have to think into the future. It's always about the future when it comes to investing. We have things that we know and things that we cannot know. When you think about the future, it's very hard to know the future. If you know, please help me there. But I'm going to show you here Apple. 2016, market capitalization 500 billion, cash 200 billion, P ratio of 9 with 50 million of net income coming in every year. In this case, when Apple was trading this cheap, the future was free. So those investing in Apple in 2016 got the future for free. And that is the value investing approach, a prudent approach on what is known. And if there is future upside, great. But you want a margin of safety where you get the future upside for free. As I always say, worst case scenario, am I okay with a P ratio of 9? Likely yes. And then everything that has happened for free. And the market is crazy irrational, so that you get these opportunities to get such upside for free more often than not. Perhaps also something that helps is to look at natural laws. I remember 4 years ago the ARK Invest bad ideas, and the bad ideas discussed, I think, railroads, because everything will be displaced by drones. And then you go back to 2009, Buffett buying Burlington Northern, and in the last letter to shareholders, he said how rail is essential to America's economic future. It's clearly the most efficient way, measured by cost, fuel usage, and carbon intensity, of moving heavy materials to distant destinations. So, something that helps about the future are natural laws. Will there be more people globally? Likely yes, in the next 10-20 years, especially from emerging markets. Will the population in developed markets decline? Yes. So that's all things that are natural laws. Is it better to slide manure on a train than to drone it around the country? Yes. So you can always have some more certainty by looking at natural laws that don't change and will never change, rather than have some other crazy ideas. So always be prudent when it comes to investing. In that line, risk comes first when it comes to value investing, not hope. And that's also something that we have seen here recently with the DeepSeek situation. I don't know what will it look in 2, 3, 4, 5 years, but I just know that I don't want to base my investments on some hope that the billions invested in AI will lead to billions in profits. That's something that we will have to see. I hope it works for all those invested, but that's not the value investing way. Another way to estimate the margin of safety is to look at the value for the private owner. This is a company that we recently discussed, JDE Peet's, trading now at 16 euros per share, but just a few months ago, the owner paid 25 euros per share for the Mondelez 17.6% stake. So that's a pretty big margin of safety. You know, private investors are willing to pay 25, you pay 16. There is a pretty decent margin of safety that even if things go very wrong, there will be someone paying 16 to, let's say, bail you out and save you there. The next way to look at the margin of safety is to focus always on absolute returns, not relative. What do I mean with absolute returns? Well, Warren Buffett always shows us what his businesses make per year. So we can say that Berkshire will likely make 40, worst case scenario recession, 30 billion per year. And then you compare the 30 billion to the price to get an absolute return on your investment. And you do that for every business like we do in the intrinsic value calculation. And then you know, okay, worst case scenario, am I happy with the key driver of returns? And that's the value created by the businesses. Next component is patience. I cannot guarantee you that I can find you an investment with a margin of safety at every second and every moment in time. But I can guarantee you that such investments come around more often than not. Berkshire was trading at 400 billion a few years ago, now it's trading at 1 trillion. Warren Buffett even cut his buybacks, etc. So it doesn't have that margin of safety, even if it has in some forms. So this leads to being patient to find the key margin of safety, and that's the price paid. The lower the price, the higher the returns, the lower the risk, and that's simple mathematics. Let's now apply this to Berkshire Hathaway. So Berkshire Hathaway, here we go with the calculation, and I have the market capitalization, I have the net income as yearly value creation of 40 billion. I think that that's an average for Berkshire. Maybe we could put 35, but I think long term it will be there. Warren Buffett is investing 8 to 10% targeted returns, so the growth rate, I think it's okay that it is 6% there. I target a 10% return, thus the discount rate, terminal multiple. For Berkshire in history has been between 10 and 20, now a little bit higher with 25, but let's take the average. On that average, the terminal value in 10 years is 1 trillion, so the intrinsic value for a 10% return is 390. If Berkshire grows a little bit faster, if we put the current terminal multiple, then for a 10% return, the value is a little bit higher. Worst case scenario, P ratio of just 12, then it is down to 300 billion. Sum of parts, let's say 500 billion for a margin of safety intrinsic value for a 10% expected return. And you can see here that it is on the expensive side for, let's say, investing now in Berkshire. Next we have book value, total shareholders equity 631 billion, so that's the value created by Berkshire over the last 5 decades. If you can buy it cheaper, then Berkshire is a strong buy. When it comes to business quality, Berkshire is a financial fortress and one of the few businesses built to last for the next century, and therefore I would give it a 100% fortress ratio. What's the future? Well, we have the earnings there, but if you look at the businesses they own, insurance will be there, railroad, utilities, energy, other businesses. When you look at all the other businesses, some will do better, some will do worse, but in general, if the economy keeps on going, if you keep living, Berkshire will keep living. That covers the long term. Let's look at Berkshire, and this is a very interesting perspective, value to private owner. I have made some calculations, and then we have insurance, railroad, utilities, all the other businesses, and what's the value to private owner? Now, the recent Canadian Pacific Kansas City Southern acquisition was made at 30 times earnings, which would put Burlington Northern at 150 billion, but at 10 times earnings, it's 50 billion. Energy, 10 times earnings, around 30, maybe a little bit higher in this environment. Let's put 100 billion on the insurance without the float. Other businesses from 10 times earnings to 20 times earnings. There is the cash that's easy to value, and the stock market, we can argue, but for the sake of the exercise, let's just put it like that. Total businesses, stocks, 920 billion would be the value of Berkshire in the current environment. So you say if Berkshire would go into liquidation, that would certainly give a margin of safety. So if you can buy at 700 billion, then you already have some kind of margin of safety there. Patience on Berkshire, the P ratio from 10 to 20, now it's 25. Berkshire is therefore on the expensive side. Absolute return, I think with the stock market, with this, we are at 40 billion. Of course, if the price is 400, then you get a 10% return, and everything else is free upside, as we discussed. Here is the summary of Berkshire. Intrinsic value, 500 billion, book value, a little bit higher, cash, great. So you can also deduct it from the values there, but keep in mind, the cash is having now 13 billion value creation yield from the treasuries, great business quality, 30 to 40 billion per year, long-term perspective strong and always growing. Risk first, that would be what can happen in a negative scenario. Every here and there for the last 40 years, Warren has been called old, happens once in a decade, so it will likely happen again. The value to private owner, in a fire sale, likely less, but in a liquidation over time, I think it would hit something like this. Absolute returns and the patience, we are now at 25, so I would say, okay, let's wait that Warren Buffett does buybacks, then you have a good return from Berkshire. I hope you enjoyed this. Check my full value investing course. Thanks for watching. I'll see you in the next video.